What I want to do here is I want to use an example to do the closing journal entries. And remember, closing journal entries are done after you've done your general journal entries, after you've done your adjusting journal entries, after you've created your financial statements. That's the time for doing your closing journal entries. So in order to do a problem, what I did is I created a very simple business, has 7 transactions, 6 general journal entries, 1 adjusting journal entry. And then I created the financial statements. And again, this is not I'm not trying to show you how to do financial statements. I'm not showing the general journal entries. Really what the focus of this video is to try to teach the closing journal entries. But in order to do closing journal entries, we've got to do the other entries and other things first. So let me go over the problem. And again, a very simple business, 7 transactions in total. First transaction, was transaction A, where we invested $100,000 into the business. So we debited cash for $100,000, credited capital for $100,000. Second transaction, we did some work, and we got paid $2,500 in cash. So that's a debit to cash for $2,500 because we received it, credit to service revenue for $2,500. Third transaction is we paid our landlord $1,000 in cash. That's a debit to the rent expense for $1,000, credit to cash for $1,000. That's adjusting journal entry number C. I'm not adjusting journal, but general journal entry C. General journal entry D, fourth one in, is we paid our salary or paid our employees $500 in wages. So that's a debit to wages expense, credit to cash. E is we withdrew $5,000 of cash from the business, so the owner paid themselves. So that's a debit to drawing for $5,000 and a credit to cash for $5,000. And then the last general journal entry is we went to the store and bought $3,000 of supplies and we just wrote a check for it. So we paid cash for that. So that's a credit to cash for $3,000. And a debit to supplies for $3,000. The one and only adjusting journal that we have, because we have to do adjusting journal entries after we do the general journal entry, the one and only adjusting journal entry was we counted our supplies. There was $2,700 worth of supplies at the end of the period. We then adjusted the supplies account from the $3,000 that was in the supplies down to $2,700, and the way that we did that was credited supplies for $300, and then we debited supplies expense for $300. So those are our transactions. Those are the general journal entries and the one adjusting journal entry. Once I did that, I created the financial statements. Again, there would be a title, there would be a proper title showing the date, the range of time, whatever this is for. But again, just to show you, so we got service revenue of $2,500 here. Then I listed my 3 expenses. That's rent expense, wages expense, and supplies expense. Listed those, and those were subtracted from the service revenue. Gave me a net income of $700. So that's my income statement. Then I create my statement of owner's equity. Beginning owner's equity is 0. Plus additional investment was the $100,000 of cash. Plus the net income that came from the income statement, less the drawing. Gives me ending owner's equity of $95,700. After I did that, then I did my balance sheet. There's only 2 assets on the balance sheet. Cash, which was $93,000. If you add up the debits over here and subtract out the credits, you're going to find $93,000 worth of cash. Supplies is the $2,700. So I have $95,700 worth of assets on the left. I have no liabilities, and then owner's equity is just pulled from the owner's equity statement over here. So that's $95,007. So I have $95,007 on both sides of the balance sheet. All right. So once I've created my financial statements, which I've done the first 3 anyway, the next step I need to do is I need to do the closing journal entries. Okay. And so it's very important. There's only 4 closing entries, and the first one that I always do is I close down the revenue account or accounts. So in this case, we only have 1 revenue account. It's called service revenue. And when I say close down, what I mean is bring that revenue account down to 0. So if we have a $2,500 credit balance, in order to make it 0, we're going to have to debit service revenue for $2,500. And if we debit something for $2,500, we got to credit something for $2,500. And the account that we are going to credit is income summary. Now, income summary is just a very simple temporary account that we're only going to have open just for the purposes of closing down the account. So income summary is the account that we are going to credit. So that's the first closing entry, is to close down the revenue account. The next closing entry is to close down all of the expense accounts. So we have 3 expense accounts. We have rent expense, wages expense, and supplies expense. All of those expenses have a debit balance, like expenses normally do. So what we're going to have to do is we're going to have to make, in order to make those accounts zero, we're going to have to credit those accounts for whatever's in them. So second closing entry is to close down the expense accounts. So rent expense, I'm going to credit for the $1,000. Wages expense, I'm going to credit for the $500, which is in wages expense. And then supplies expense, I'm going to credit for the $300, which is in the supplies expense. So if I do that for all of them, I will make those accounts zero. And that's what the goal is. All right, so now I've got $1,800 worth of credits. I need $1,800 worth of debits. And the account that I'm going to debit is that temporary income summary accounts. So $1,800 goes into the debit side. Okay, so third closing entry is to close down the income summary account. So if the income summary account has $2,500 worth of credits, $1,800 worth of debits, that means it has a $700 credit balance. Now that $700 credit balance matches my income statement. Okay, so it's kind of like a way of checking to make sure you've closed down all of your accounts. So if I want to make this account zero, close down that account, and as it has a $700 credit balance, then the account that we are going to debit we're going to have to debit this account $700, right? So what I'm going to do is I'm going to debit income summary for the $700, and if I debit something for $700, I got to credit something for $700, and the account that I am going to credit for the $700 is the capital account. Now remember, capital goes up when we credit it, and it makes sense because we have net income that increases the owner's capital. All right, so that's third of 4 closing entries. Fourth and final closing entry is to shut down or close down the drawing account. So drawing has a debit balance of $5,000. I want to make it zero, so I'm going to have to credit the drawing account. Credit the drawing account for $5,000. And that will make my drawing account zero. And if I credit drawing for $5,000, I got to debit something for $5,000. And the account that I am going to debit for $5,000 is the capital account. So capital would get debited for $5,000. And if I have $5,000 worth of debits, $100,700 worth of credits, then when I do the math here, then I'm going to have $95,700 worth of credits in my capital account. And this number here matches my owner's equity number that's on the balance sheet or at the end of the owner's equity statement. And so notice what I've done is I've closed down the income accounts, I've closed down the expense accounts, closed down that temporary income summary account, and closed down the drawing account. Obviously, I did not close down any asset accounts. If you had $93,000 of cash at the beginning of the period or at the end of the period, you're going to have $93,000 of cash at the beginning of the next period. So you don't. The only accounts you close down are income accounts and expense accounts and the drawing account and this temporary income summary account. Everything else you leave the same. The other thing where a lot of students make a mistake is they will say, well, total expenses are $1,800. So they'll credit something called total expenses. And total expenses is not an account. It's a summation of all the accounts. So unfortunately, you have to credit each individual expense account. So don't get lazy and just put total expenses $1,800 for the credit here at this thing here. All right. Hopefully that helps with the closing entries. Again, closing entries are done at the end of the period after you've done all your financial statements, but before you start the next accounting cycle.